Now let's check some sales transactions. In this example, it says that we sold $4,500 of merchandise on account to NetSoft Company, terms 210 and 30, FOB destination. The cost of merchandise sold was $3,000. So now for these 4 transactions, we will record it in the journal, assuming that we are using a perpetual inventory system. We said before, in a perpetual system, we will update inventory account for each purchase or sale, or purchase return or sales return, because these transactions will affect the value of inventory. So for a sale of inventory, we will have 2 journal entries. First of all, we want to recognize the expense that will come from this transaction, and we will make another journal for another entry for the expense that will come from this transaction. So I made a sale on account, so I will debit accounts payable by the selling price, accounts receivable, sorry, and I will credit the revenue account, which is called sales, or we might call it sales revenue. So I will debit accounts receivable by the selling price, which is 4,500, and credit sales by 4,500. Now also for at the same date, I will update, I will debit cost of goods sold, and I will credit inventory, because inventory on hand will decrease by the cost of this inventory. So we have 3,000, and for this one 3,000. So for a sale transaction in a merchandising company, you need 2 journal entries and you need 2 figures. You want to know how much is the cost of this inventory that we sold, and we want to know what is the selling price, or the revenue generated from this transaction, which is the sales amount. So this is what we should record on May 10. On May 11, said we paid $300 cash as a freight on May 10 sales. I will debit account called freight out, and this freight out is an expense. It's a type of expenses. So this one will not affect the value of inventory, because the cost of inventory includes the cost that we need to get the inventory. But whenever we had the inventory in our stores, then the selling cost, freight in is just, freight out is a type of selling expenses. So this will be a period costs, will be recorded as an expense, and it will not be part of the cost of the inventory. So I will debit freight out and credit cash for the amount paid. So we paid the freight, as you can see, 300, and cash will be credited by 300. Next one, May 12, issued a credit memo to NetSoft Company for the return of 1,500 merchandise. The merchandise returned cost 1,000. So now we retained some of the merchandise sold later. Sorry, the customer retained some of the merchandise that he bought before. So now we will have two journal entries again. So sales and sales returns, we will have two journal entries. The first one, I will debit sales returns and I will credit accounts receivable by the selling price. So this amount that sold for the customer for 1,500. So I will credit accounts receivable. So the receivable that the customer have to pay will decrease by 1,500 because he retained some of this inventory to the company. Now, what is sales returns? What type of account is this one? Sales returns is simply a contra sales account. So sales usually to get net sales we have to deduct from sales returns. So sales returns is an account that will be deducted from sales. That's why we call it a contra revenue account, because it's or contra sales account, because it will be deducted from sales. Now also we have to do at the same date, we have to reverse the second journal entry related to the cost of goods sold, because now when the customer return the inventory will be increased and cost of goods sold will be decreased. So now here I will, the cost of this inventory returned is 1,000 and cost of goods sold will decrease. So it just simply we reversed the journal entry because now they returned inventory, so inventory increased, so the cost of the goods that we sold before decreased again. So we credited, now we are crediting cost of goods sold. Now finally, May 18, received collections in full from NetSoft. To finish this one, to finish the last transaction, we have to do some calculations. So now, what we have to pay exactly. First of all, let's check the accounts receivable balance. Okay, accounts receivable, it was 30 or 4,000, it was 4,500, but the customer retained some of the merchandise, so we decreased receivables by 1,500. So now we only want from customer an amount of 3,000. But we have some credit terms. As you see from the credit terms, the seller, which is our company, promised the customer if he paid within 10 days, he will get a discount of 2%. 2% of the receivables amount. So the sale happened on May 10. So the customer paid on May 18. So he paid